Hey everybody, it's Chris with Life 180, and I'm here with Galen Nuttall from Canadian Whiteboard Finance, and we have a fun video. We were just talking how we do these calls. We basically get on here. I ask Galen what he wants to talk about, and he's telling me, well, why don't you tell them what we're talking about today?
We're going to be talking about interest rates and how rising and lowering interest rates affect the concept of infinite banking.
Awesome.
Or whole life insurance, however you want to call it, participating life insurance.
So the idea is people are worried about that we've been in this low interest rate environment for all-time record lengths. And so that has put a lot of stress on the fixed market, which puts a lot of stress on life insurance and companies' ability to create guaranteed returns. And so in the United States, they've just, there have been changes to Section 7702 that's reduced the guarantees inside of it's given insurance companies the ability to reduce guarantees. Not all have done it yet. Not all necessarily will do it, but they have the flexibility. So I think a lot of people are really concerned, is infinite banking as good? Is this what you're saying? Like infinite banking might not be as good if the guarantees aren't as good? Is that the idea?
Certainly it's one of the questions people come to me with, and they say, Galen, they'll come to me with a couple things, either questions or preconceived notions around how interest rates might affect the way that whole life insurance policies are going to grow over the next bit. So one of the things they come to the table with is the broad question: how will continually low interest rates affect the growth of these policies?
Okay.
And the assumption that people bring to the table sometimes is like, oh, well, as soon as they go back up, so will policy growth. And that's not usually how it works. So it's just one of the questions people come to the table with a lot, because people who understand how interest rates work and how, like you're saying, the growth of policies very much depends on some of the more, the less volatile investments out there, like the fixed income side of things.
Yeah.
And fixed, interest rates are insanely low right now. You can get a mortgage in Canada for like 1.8% or something like
ridiculous.
that. And prime is low, everything's low, right? And all that affects insurance growth. So it's a good topic to talk about, so people come to the table armed with knowledge of how does this really work. And it's something we'll see. I've gone into it. I have my philosophy and history, looking at it, which is why I'm sporting my 70s hairstyle. It's
nice.
Hopping in a time machine back to 1970s, 80s,
I love
90s, when interest rates were either high or low or very volatile. Back in the day,
totally.
Before they were controlled as they are today, they were all over the place, right?
Well, I think it's the nature of things got out of control economically. Yeah. I can't speak to Canada, but in the United States, it all started in 1971 when we went off the gold standard. And of course, what we do impacts the rest of the world. And when you go off the gold standard is that kind of checks and balances element, or it was, to our entire economy. But because of Vietnam, all these different things, we couldn't pay back our debt. The only way to pay back our debt was essentially to go off the gold standard, which effectively is defaulting on our debt. Nobody likes to talk about that, but that's what it is. Because all you're doing is saying, okay, we're just going to inflate our currency. And so, because now we can print more money because we don't have to have it backed by gold. And so 1971, and it's funny, if you look at inflation rates or appreciation rates of housing for the 80 years previous to 1971, it was this nice, slow, consistent growth that kind of matched inflation. And it was, whatever. And then from 71, when we got off the gold standard, to 2000, housing prices just boom, through the roof. Do you think it's a coincidence? It's not, but in the 70s, just to kind of go back in time, interest rates were they went really low to help pay back our debt, and they printed a bunch of money, and then they got out of control. And interest rate or inflation got out of control because of all the money printing. It went to 13% at one point in time by 1978. And the federal funds rate was at about 6% in 1979. And then, who I consider one of the heroes economically in the United States, Paul Volcker, who was the chairman of the Fed at the time, raised rates in 1979, literally almost overnight, to 19%. I don't know what they did in Canada, but imagine the federal funds rate right now going from 0 and increasing 13%. Imagine, because it was a 13% bump, right?
30% bump.
But
got it.
If you understand how Keynesian economics work and our fiat currency system and how inflation works, we have an elastic currency, meaning the Federal Reserve in the United States has the ability to print money, has the ability to take the money out of circulation. So when they reduce interest rates and we print money, what we're doing is we're putting more money into circulation.
Yep.
That creates inflation. But the idea is to create stimulus, right? To create stimulation to the economy during challenging times. So the idea is like, hey, when times are tough, we can reduce interest rates, we can print money, we can jam money into the economy to help support the economy when times are tough so nobody feels it is bad. And then once it recovers, then we're going to raise interest rates. That will in turn pull the money back out of the economy. Right. And that's how it's supposed to work. But the reality is, I mean, where we are right now, our debt just keeps going up. Our unfunded liabilities just keep going up. They keep printing more and more money. We've printed 33% of the money we've ever printed in circulation has been printed in the last 18 months in the United States, ever, all time, in 18 months. And it's, you know, they can't raise interest rates because of the fact, if they do, it'll collapse the economy. So they're damned if they do, damned if they don't. Yeah. And so that's kind of like my history lesson on that. But like, I have a lot of opinions on where we go from here, with the full caveat of saying, I don't know which direction it's ultimately going to go, because the one thing I used to underestimate was the government's ability to manipulate things.
Yeah. And I think, I mean, it's exactly like you're putting it, like what the Fed or anyone who's controlling interest rates, Bank of Canada, whatever, what they're trying to do is affect people's behavior. And the thing is that people are not entirely predictable. And like when given the chance, and it's actually a concept from, I'd heard of it before I read the Become Your Own Banker book, but it's that idea of Parkinson's law. Like, Parkinson came up with this, his idea was like, if you give yourself an hour to do something, it's going to take you an hour to do it. So it's kind of like the task will fill the appointed time. Yep. And I think it's very similar with economics, where people's lifestyle will fill by default, a lot of people's lifestyle will just fill to their capacity. And so what we're seeing up here in Canada is housing prices in Canada have risen higher than any other country in the world by a wide margin. Like where I live, I'd say housing prices have almost, in some places, they've almost doubled in like a few years, which is just insane. Like when I moved to where I live, like a $400,000 house was like, I mean, that was like a big, nice house. Like you couldn't find much more than that. Totally. And that was like, it was like you had to be like pretty well off to like do that, to pull that off. Now a $400,000 house is like, and where I live, like those $400,000 houses are now costing like 800 or 850. Like it's wild. Let's talk about
that. Why is that, do you think? I mean, I have my opinion.
Well, up here in Canada, there's a lot of reasons. The main reason is because people from the big cities are selling their property. They're capitalizing on all that tax-free growth because your principal residence is not taxable in Canada. Yep. So they capitalize on all that growth. So someone in Toronto who bought a house in the 80s or 90s for like $100,000 now sells it for like 1.5 million. They sell it. They come to Belleville where I live. They take that 1.5 million, they pocket most of it, and then they buy a really nice house for like $600,000. Yeah. People here are selling them. And some of them are moving into places, a lot of people are moving out to like the East Coast of Canada where you can still get a house for like 300, 400, or they're going to smaller towns. Like, so it's this really weird shuffling of people because big reason because of the pandemic. That's why it's accelerated a lot. Like my area was starting to grow because it got very popular for tourists. Yeah. But the pandemic and remote work has really accelerated whatever was happening, because people in Toronto that used to have to live downtown don't have to anymore. So they're selling their houses and they're moving out here. And I'm not sure who's buying theirs. I think there's a lot of speculation in the real estate market where people are gobbling it up and just expecting it to just always be a win. So that's the big reason why it's happening up here for sure. And the real big issue is that there are people who, and we'll tie it back to like, to whole life in a minute, but the real impact there is, young professionals, even like in Toronto, I've had clients for years who are like straight up professionals, like accountants, lawyers, people like that who have not been able to buy a decent home in Toronto for a while because of all the speculation. Now it's like impossible. Like someone starting out right now to cough up a down payment on a house that big, and take on a mortgage that big, like their interest rates are really low. So people are taking out these massive mortgages that they wouldn't be taking out. Like you were saying, like, well, when rates were like 13%, no one would be taking on mortgages this big. Like it's unfeasible.
So there's two or three things I would say to that, just bringing it back to the interest rate conversation. And in this, when we get through this, it'll make sense how it kind of impacts whole life insurance as well. Yeah. But the bottom line is the house nobody pays cash for a house. I mean, it's such a small percentage of people that actually pay cash for homes, especially single family homes, like, primary residencies. It's such a small percentage that it's almost inconsequential, to the economy. So houses are not worth $500,000. You take your $400,000 house, and what year was that? Do you think it was worth 400,000?
Let's say 2010.
2010. So you take your $400,000 house, and then you take it and you say, okay, today it's 850. I mean, there's things that come into play there. I mean, inflation is going to impact housing, right? I mean, it's going to drive housing up, and that plays into it. And people don't like to talk about that. But if you have 3% inflation, every 30 years or so, the cost of money halves, right? Exactly. Or like if it takes you $100,000 to live today, 30 years from now, it's going to cost you $200,000 to live.
Absolutely.
That's just a fundamental, foundation. But the one thing, I'm going to share my screen real quick.
Sure.
The one thing, I don't want that. Where is
Close your eyes, everyone.
Yeah, exactly. Here we go. So this is something to like understand is when you buy a house, you don't pay the house value is not based on 400,000. It's based on this number right here, the 1764.
Yeah,
right?
Absolutely.
I mean, that's just it. So if you go back to 2010, if you could get a mortgage rate, right, that was, remember back in 2000, if you had a $400,000 house, the mortgage rate was like 6.5%, 6 to 6.5%. So you're talking a 30-year mortgage rate. That house is $2,528, right? Yeah. So now in Canada, you're saying people could get 1.8% interest rates, right?
Yep.
So I mean, and you take, so inflation is naturally going to drive that 400,000 up anyway. So that's going to happen. But then you take into account, remember, the house wasn't worth 400,000. It was worth 2,528 a month. So now we go, let's go to today and say, okay, well, it's 1.8%, right?
1,800. Yeah.
2,528 is the number we need to get to. So just to keep it even without inflation, let's just figure out.
You'd have to take it up to like,
look at that. Way more. Oh, wait.
You'd have to take it up to like 850, 900.
Look at that. So, I mean, it's literally almost 800,000. So did the market really appreciate much? I mean, that would be the number, because when you take inflation over the decade and you take, it's just manipulation in the interest rates. So here's the risk right now is that did the housing market do really well? I would argue, no, it hasn't done well at all. They keep manipulating interest rates to get people into these houses. And listen, I bought a house last year. I took advantage of this. I've got a house that's appreciated almost 300 grand in the last year. It's insane. Phoenix is the top growth area in the whole United States. I was just reading an article on it yesterday. So, cool. It's crazy. And I'm sitting here going, do I want to sell my house? Right? Because like mathematically, I'm like, okay, I feel like I'd be a fool to not sell this house. But then I'm like, well, I bought this house saying it was kind of like the house I'd be happy to live in for the rest of my life, because we have a beautiful view on a golf course, wraparound golf course, lake in the background. Like, I mean, it's amazing, but I'm sitting here going, well, mathematically, like, so it's just really hard. But here's the deal. Like, take a look at this. So if I raise, if 2878 is my number, okay. Yep. And that's what I qualify for. What happens here? If I go to 2.8, actually, you know what? I want to keep it simple. I'm going to go to 2 here.
Go to 2.
I'm going to go to 2. So 2957. Okay. So if we're at 2% interest rates and I have 2957, and that's what I qualify for my mortgage. If that is my number. Now let's assume that when interest rates increase, the economy doesn't struggle and unemployment rates don't go up. Let's just assume they're raising interest rates because the economy is good.
Right.
Okay? The idea is income will go up, but I think most people in the world don't believe that the economy is going to get so good that interest rates are going to rise. The stock market's going to continue to go great. Incomes are going to accelerate. Like, I think most people are really scared about that. And so if you go to 3%, remember, I got to get this to 2957. So I'm going to go 720. Still not. Oh boy, that's worse than I thought it was. 2951. That's close enough. Okay. So that house went down 12.5%. The interest rates went up 1%. The housing market, if all things remained equal and that person still qualified for 2951, that 1% increase in housing loan makes it so that housing value has to come down 12.5% for that same person to be able to afford it.
Yeah.
That's mind blowing.
Yeah.
So when you look at it at the beginning of the pandemic, what were interest rates? 4.5, right? Housing prices have gone up. How much? About 30% in really booming markets, right? What are they now? They're down to 1.8. So if the person could afford for that 2957, what is that? No, it's higher than that. 590. Close enough. 580 we'll go. 585. Close enough, right? So that house that was worth 585, okay, and we started off at 800. So that's about right, honestly. I mean, I'll put it out there. My house I bought for 603, and it's worth almost 900 now, which is insane.
Yeah.
But you look at this. This was I bought my house right at the very beginning of the pandemic. So I'm like literally January 24th, right before the pandemic started.
Yeah.
I bought my house. So it was like a month right before, right?
Yeah.
And at 585, I bought at 603, but let's just use this number. That goes up to 800. Yeah. What is that? 585 divided by 800. What percentage increase is that? That's like a 33. That's about what the market's doing. So did the market really go up? No.
Yeah.
They just keep dropping interest rates. And is that a sustainable thing?
Absolutely not.
No. Right. And so the real estate market is gonna, I believe, if you want to live in your house forever, then just ride the wave and it'll be fine. You'll be okay. Because the bottom line is it doesn't matter the equity you have in your house. I will encourage everybody to think about, if you want the equity, if you want to cash out now.
Yeah.
Realize that you may need to rent for a little while to allow prices to come down. And honestly, we don't know if they will come down anytime soon, because the government has the ability to manipulate, right?
Yeah, exactly.
But the equity you have in your house right now, I'll tell you, is not real. It's not real,
No.
And it's, I worry that people feel wealthy because they got 300 grand of equity in their house.
Right.
That is kind of artificial, right?
Yeah.
And,
for sure.
And that makes me concerned. Now, coming back to whole life, when you understand these principles, here's the bottom line. I'll stop sharing. So we go back to Paul Volcker, 1979. Let's talk about that principle. He raises interest rates. And I was born in 1980. So 1980, what happens? Real estate market crashes, stock market crashes.
Yeah.
1980, 1981 were horrible years. And you can look at that time was like a hugely pivotal time, because in the United States, 401ks were created.
Right.
It was a big transitional period. Interest rates, a mortgage rate was 22%, right? So if everybody that goes, oh, well, houses do nothing but go up, right? Everybody, you could buy a whole life policy back then. The dividend rate in a policy was 16%.
Yeah.
Right? That seems really good. But here's the problem. We lived in this environment where we lived in a reducing interest rate environment, a declining interest rate environment for 35, 40 years now.
Yeah.
Right? Well, I would say 30 years, because from 80 to 2009, the interest rates did nothing but decline.
Yeah.
And then in 2009, 10, they created QE1, QE2, QE3. They started printing money. More money now. And now, because we're losing our ability to keep reducing interest rates, so they just keep printing money.
Yeah.
All sorts of other issues. And so, but the bottom line is this can't keep happening. And so if you were a life insurance agent, or you bought a life insurance policy, a lot of the argument that people have is like, well, whole life insurance never performs according to what it shows you it's going to, right? Why? Because they're having to show illustrations based on, you have the guaranteed column, which guarantees, but everybody's like, wow, they've always matched their dividend, right? So you don't have to rely on the guarantee. But the current illustrative rate, at least in the United States, I don't know how it works in Canada, but the current illustrated rate is based on what the current dividend rates are. So if we're in 2004, where dividend rates were 8% or 7.5%. That's the current rate. So now that they're 4.5%, they've been reducing year after year after year after year, and so it's going to underperform. But now, what I'm telling people is we are truly living in an environment where interest rates could go up, right? I mean, if they don't, we're going to end up being China, or we're going to end up being Japan, not China, Japan.
Right.
And if you don't know about Japan, they were crushing it economically. Everybody thought they were going to like go to the next world superpower because they started creating more cars and being a bigger player in the world economy with electronics and manufacturing and stuff like that. But because of their economic policy, you look at them now and the yen has lost a ton of value. Their market has gone through the roof, but the quality of life has not done anything. And, you know, it's the investments there are horrible. Inflation has been a massive problem. And I would really encourage people to look at what Japan did between then and now and say, is that what we want for America? Right? Because we're at this tipping point. It's 1979 all over again right now, right? Yeah. We can either increase interest rates and do Paul Volcker 2.0 and have a hard time, right? Have austerity, reset the economy, regain responsibility, take it in the chin a little bit, have a couple hard years and reset and have a chance to rebuild. Right. Or we can keep trying to play the games, which is what we're doing right now, and turn into Japan and lose our status as the world's reserve currency because nobody's going to trust us, which doesn't matter to you so much in Canada, but it does to us. Right.
Well, like you said, it impacts everything. I mean, when a world superpower like big currency does something, and I mean, definitely, I mean, so like you're right. Like, so in Canada, when we run an illustration, we show what's called the primary rate, which is the current rate, and then the reduced rate, which kind of shows what's going to happen if the rate is reduced by X, and we can actually change it. Like we can make it even lower. And so you have to do that. And I mean, one of the reasons I say to people that is back when interest rates were higher and agents were illustrating, this is when you're going to be able to offset. It was always based on that time. And then I've had not clients that I started with, but people who started these policies years ago, all of a sudden not have the policy sustain itself anymore because the dividend hasn't kept up with what they said it would. So I always caution people to err on the side of caution with those things. Like if it says you're going to offset in this many years or whatever, like we want to make sure it's really going to do that. You know, I always tell people to be a little bit on the careful side. And I mean, what I find really fascinating is I looked at this case study years ago because I find that a lot of times people, they get caught up on the today's dividend scale interest rate. And they're like, I'm going to pick the company that has the highest one today. And I don't think that that's the best way to start because there's reasons why some companies illustrate higher than others. Like I'm a big fan of looking at everything, like the whole health of the pooled fund of the organization for sure. Because some companies in Canada left the market and then came back and they treat people who came in at different times in different ways. I mean, there's all sorts of things, but there was a guy like back in the 80s and he's like, all right, this company and this company are illustrating different interest rates. And so he's like, he was going to put like, I think 40 grand a year into life insurance. And he said, this one is 2% higher than this one or something like that. And he's like, so he ended up splitting the difference. He's like, I'm going to put 20 in one and 20 in the other and see who wins in the future. And so this is actually a real case study that this advisor tracked and kept track of. So the projections showed this massive difference 20 years out, like 2% per year over 20 years is going to be like a really big difference, right? But what did the dividend scale interest rate do for each of those companies? Like one would lower their rate one year, the other one wouldn't.
Balance it out.
Then one would and the other one wouldn't. And they just kept doing that. And by the end, like this projected like massive difference came down to like a very slim difference where any given year one was winning and one was losing, winning and losing. Yeah. So I do tell people like there's much more to what's going on than just the dividend scale. And at the end of the day, a lot of companies, like, and every company knows what every other company is doing. Like, I mean, there's whole charts that just break down what every company is doing. So they look at it and they do what they can. But yeah, I mean, the big thing about the interest rates is the other thing that advisors were saying when I started in 2013 is they kept saying things like, oh, the interest rates can't possibly go any lower. In 2013, when I became a financial advisor, advisors kept saying that. It can't go any lower than this. Like, come on. And it just kept getting lower and lower and lower. And so I always caution people, like, even if it does, like, so even when it does go back up, there is, at least the way most of the pooled funds that I've looked at work, is there's going to be some lag time in the dividend scale interest rate for it to start going up too. Like it's probably going to lag behind. But at the end of the day, like if people are looking for tax efficiency, a guaranteed component of growth, a dividend component of growth that's never skipped a year, all the borrowing opportunities, like those things are all going to be solid no matter where the interest rates go. But it's like, it's a good thing to kind of understand where it fits in.
Well, and we talk about, you know, when I talk about it, I always call, I know a lot of people talk about infinite banking, but we call it the and asset, right? Because and conversation. It's not an either or conversation. And so the reality is when people go, is infinite banking, you know, going to disappear because of these low interest rates, and it doesn't make sense, and whole life sucks. You know, that's what a lot of people say. Whole life, because the interest rates being so low, and why would you want to invest in a policy like that? Because it's not an investment. You know, it's a storage vehicle. It's a safe, guaranteed, liquid, accessible, usable storage tank for your money. And at the end of the day, like fundamentally speaking, I do a video on this. I'm gonna share my screen again. I'm gonna do a whiteboard real quick. And I really horrible handwriting on this. So bear with me. But like at the end of the day, you know, I talk about this one talk where I do a financial pyramid, right? And, you know, when you talk about financial structure, my big belief is the reason that the wealthy are getting wealthy and the middle class is getting poorer is because of, you know, let's see if I can just do this, because of safe money, right? Right. And, you know, safety is your insurances, making sure that you're protected in emergency, all that stuff. Mm-hmm. But I'm a big believer that, you know, when you have the world that is living like this and they're investing, this is high risk, this is medium, this is safe. The world, when people do this, this is the way the world goes. They put their money into RRSPs. Is that what they're called?
Yep.
They put them into 401ks, IRAs, stuff like that. And they invest and they look at it. And for a 10-year period, the market does really well. But the thing is, and I don't know, I can't speak to it completely cleanly in Canada, but in the United States, they got it in a 401k. They're fully employed. They feel really good. Things are going well. Mm-hmm. But the thing is, they have no money in safe. They have no, like people maybe have $2,000 in case of emergency in a safe because maybe they have, you know, 60K over here or something like that. And that's even being generous, right? Sitting in a high account. But what happens, a time like 2008 happens, COVID happens, they lose their job, they lose half the value, 30%, 40%, 50% of the value, and they lose their job. And now they need money. So this account value goes down, but all the while they're going to have to take it out just to survive when they lose their job because they have no safe money, right?
Yep.
And that creates problems. So the thing that I love about whole life, where I think it is always going to work, is because it's not about whole life. It's about this concept of building a financial pyramid, building your money from the ground up, building your financial world from the ground up, making sure that you have your foundation of safety, guaranteed access to capital, having a safety account, having an opportunity account. Because if you talk to people, I would say, you know, so if you get that, what I talk to people about is I say, listen, do you believe that you should have money in a safe, liquid, accessible account if you come on an emergency? Well, what's an emergency? Your air conditioner blows up at your house.
Right.
You know, you lose your job for 6 months, 7 months, 8 months, 9 months, 10 months, right? Like you need to be able to pay your bills, all that stuff. Do you believe you should have that safety? I think most people go, well, yeah, I do. Right. And a lot of people feel like, you know, this is kind of their backup, you know, in case of emergency, break open glass, but they don't realize the cost of going that direction, right? Because there's such a lack of financial education and literacy, right?
Yep.
And so what you have to get people to understand is like, if that's the case, what I love about whole life is that it's not a matter, do I think infinite banking is going away? The answer is heck no, I don't. Right. Why? Because there's no other guaranteed vehicle that's going to be a leverageable asset that's going to get your dollars to do multiple things for you in a way that can do, and giving you the guaranteed rates of return with the liquidity, right? Yep. Beating the rates of your bank, because you have two options. If you want that safe, guaranteed liquid money, you either got to put your money in a savings vehicle, savings account at a bank, or a whole life policy. Really, that's it.
Yeah.
Right? You put it in a CD, you get a little better return than but you're going to lose liquidity of it. So for the most part, without charges or whatever. So that's what it comes down to. So do I think infinite banking is going to go away? The answer is no, because it still crushes. Because if you understand the importance of building your financial life like this, I'm a big believer. Nobody should even worry. And I know you may disagree with me on this, but I'm a big believer. You shouldn't even worry about this until you have 2 years of income right here.
Yeah.
Because the market is cyclical, right? It's not linear, right? It's I'm going to erase this for a sec. The market is cyclical. Sorry, I told you if you got me going on this topic, I was going to go off. So the market is cyclical. It's not linear, right? So it goes up, it comes down. It goes up, it comes down. It goes up,
yep.
And it does this. And so there's this nice slow growth curve, but the time that you want to make your money is right here,
Mm-hmm.
right?
Yep.
If you can get a good, 4 to 5% here, but then capitalize and make 60 to 100% in those moments, in these times.
Yep.
What's that look like? Now you're averaging 10% per year over that decade with less risk.
Yep.
But people have bought into this concept of buy and hold. But that's why I tell people you need 2 years of income. And that sounds like a lot. And it sounds like an unattainable number, right? It's just, for most people, it just seems like an unattainable number.
Right.
That's why I believe in just jamming money into whole life policies, because A, it's the emergency account, which everybody knows they need to have.
Yes.
Right. B, once you have your emergency account handled, keep stuffing money into this thing. This is the idea of an infinite banking concept, because it's going to be there for you no matter what. Keep stuffing money into it above and beyond your emergency, because now it's an opportunity fund. And then that you're beating inflation. You're doing this, until you get here, then you get to capitalize, you get to earn that. And then you repeat the cycle. You never lose.
Yep.
And why is there a growing gap between the wealthy and the middle class happening? Because most of the middle class is just investing in their 401k. The market tanks. They have to make bad decisions. Asset values go down. People make stupid decisions, and people with capital come in and go, those fools, that's going to bounce right back. I'm going to buy it right there.
Right.
Boom. They get wealthy. I mean,
for sure.
It's
they have options. They have choice.
Yeah. And I look at that, and it's like so straightforward and common sense when you understand that. And it's like, why doesn't everybody get this?
Yeah.
So
absolutely.
That's why I don't believe lower interest rates are going to have a negative impact on infinite banking. I think the nature of a volatile market makes infinite banking even more powerful.
Mm-hmm. Absolutely.
Low interest rates.
I mean,
more volatility. The nature of the uncertainty that we're living in, that nobody knows, creates more volatility. So more important than the interest rates, that volatility creates a need for infinite banking and safe, guaranteed, liquid, accessible money. It gives you more opportunity and control with your money.
Absolutely. Yeah, no, I certainly so when I started in 2013, I had a few clients take these on, and 6 years later, even while interest rates are technically dropping, they come back to me and say, can I still get another one of these? Like, can I do this again? Can I do this on my kids? Can I, they didn't come back after 6 years upset because the interest rates had gone down. They came back pumped because the cash value kept going up, because that safety net kept getting bigger. And they're like, now I really want to do more of this. Like, that's really the biggest thing in the early days in 2013, when I was just getting started. That's what happened. Like, the people that I put it in place for back then, a lot of them came back and said, yeah, I want more of this, or I want to put it on my kids. Like, they did the investing too. Like, they had both things going, but they really liked the idea of adding more to this. And so that's why would anyone, like, if all you're doing is measuring it by the dividend scale, people are like, why would you do more if it's dropping? And they weren't mad. They were happy. They were like, I'm glad this has kept going up. Like, they were pumped.
I'm a little different than you. I'm a bit more extreme in my beliefs, right?
Yeah.
Like, I'm just a bit more extreme in my beliefs that I truly don't believe that anybody should invest in the market personally. Like, that's just me, until you are at a certain stage, because that because of exactly what I just showed, right?
Yeah.
And I feel like any investing before you're there is just an emotionally based thing. Like, I could and the reason it's emotional is because you're going to be looking around and you're going to feel like everybody who's investing when the market's going up, it's that FOMO, that fear of missing out.
Oh yeah.
Oh man, the market did 20% last year. I only got 5% of my whole life. This is stupid. Like, why am I going to, like that's how people feel. But, you got to think long term. You just have to think long term, and you have to think from a financial strategy and structure perspective, and look at it. I just read Ray Dalio's book. I'm actually, I think, going to do a video series on the Principles book. Have you read it? It's amazing.
I haven't read that one yet, but I've watched a lot of his videos.
When I was in Costa Rica, I read the book because the eco cabin that I stayed at there was a copy of it. The guy had a copy there, and it was amazing. And it was just like, I took 2 days where I was like, had downtime. I just sat down and read this book, and I'm like, wow. Like I've flipped through it a couple times before, but I sat down and I read it, and I just like, oh man, it was amazing. And so I think I want to do a video series on that, because if people understand like what people like Ray Dalio do to be successful, they realize, and it's funny because he runs a hedge fund and he's in the markets and he's doing things differently.
Sure.
But he's in a different place. He can do that now. It's like, that can be a portion of your finances once you are ready, and people just want to get there way too quick. And they don't realize that when you do that, you're
right.
taking on so much risk that you don't even understand unnecessarily. Yep. So anyway,
sure.
All right. I'm off my soapbox. So anyway, anything else on this, bud, from you?
No, man. I mean, we definitely hit it like where it's definitely a concern people come to the table with, and they just need to understand how interest rates work and how inflation works to understand that this, this stuff is moving as much as it's ever moved. Like, people are putting this in place as much as they've ever put it in place. People aren't slowing down because interest rates are low. I'd say people might even be speeding up a little bit. And so it's not something, certainly everyone has to look at their own situation, but it's not a reason to discount it for sure.
Well, it's because the alternatives are getting worse than this is getting.
Yeah, exactly.
So is what it is. So, all right, guys. Well, if you have any questions, any comments or whatever, go ahead and leave them in the comment section below. We engage with every comment possible. So fire away. If you haven't already, would really love and appreciate a like, give the thumbs up. Also, if you haven't, hit the subscribe button. Make sure you click the bell. That way you get notified every single time we launch a new video. We do these things weekly. Hopefully you found value in this. And once again, reach out if you need anything. There's a link in the description below, so you can reach out, talk to Galen, talk to myself, whatever we can do to help you. We are here. So that's it. Until next video, have a blessed, inspirational day. We'll talk then.